how
Yeah.
are you guys handling this crisis, or how has this crisis played out compared to what you guys thought it would play out?
Yeah. So great question, and it's obviously very contextual as well. If you look at the S&P 500 chart, especially if you look at it on very long term from the 1980s, you will not only see obviously a lot of dips along the way. For example, during the tech bubble and during the global financial crisis, but also you will see that it literally like hit a wall because it lost around 30% within a span of 3 weeks, right, guys? And basically it's rebounded to around year to date now. It's down 22%. So still definitely not calling the bottom, and still definitely not saying that we're going to recover. But the speed of which is of this crisis is really astounding, right? And it's something that we didn't predict. I think the basis of every crisis is one where it was not predicted. To use um, the phrase a black swan. It's a very long tail event, and it hit everyone by surprise. So I think what we thought would have caused the next crisis would be U.S.-China trade relations or Chinese debt or something like that. We didn't expect it to come from the US. We didn't expect it to come from Europe, but it was an external health scare which really impacted the economy as a shock, and that also led to an oil shock and geopolitical tussle between OPEC and the shale producers. So this one-two punch has really taken the air out of the market. And as you guys know, it's about repricing in what we know from a day-to-day basis, right? So obviously, the first week of the drop was relatively mild. I think most of the drop came in the second and third week, where it was huge swings down followed by huge swings up, circuit breakers upon in both directions, and ultimately when you hear this is the worst since 1980s, 2008, 1930s, then we're in unprecedented times.
Perfect. Yeah, so I guess just some technical things for some people who might not have fully understood that. The whole circuit breaker thing is just the idea of, or it was actually introduced after some other scenarios in the past, right? Where the stock market suddenly dropped 20-something% in one day.
Yeah.
And that's when they're like, oh, this is an issue because the next day it bounced up 20-something%. So as if nothing happened, right?
Yeah,
so
flash crashes.
So the circuit breaker was created to prevent things like that from happening, because of course, if that happens, then it's really messy for a lot of investors going forward.
Yeah. So I just realized I didn't answer the second part of your question, TS, where you asked how are we handling all of this, right? So for those of you out there who use StashAway, you'll know that we also have an investment framework called ERA. ERA stands for Economic Regime Based Asset Allocation. If for those of you who don't know, there's a lot of material on CS's website and also on our website where you can understand how we invest. Just look up for ERAA. It's a brainchild of our CIO, Freddie. So how exactly does ERA work, and what is it doing for you in this situation? So ERA actually signposts where we are in the economic cycle. It gives you an optimal portfolio to basically invest through the cycle. So to double click on that, basically, we see as you go through your life, you'll go through different economic cycles, right? You go through a recession, a recovery, and you go through a phase of inflationary growth, and then maybe back down to a recession or that kind of cycle, maybe even a stagflation or two. So we give you guys the best asset allocation based on where we are in the economic cycle. We don't make market predictions. We don't use machine learning or deep learning or AI or anything of that sort to really predict what's going to happen, right? So we take into account economic information, things like the Conference Board Leading Economic Indicator Index, industrial production, and also inflation to determine where we are in the economic cycle. On top of that, we also have some risk management frameworks to make sure that we don't do too much and don't try and be too smart. So for example, if let's say we see growth being on the border of a recession and good times, Reggie, I think you'll know, being in the financial market, sometimes financial market signals conflict with economic signals. We actually go through an all-weather strategy where we diversify even further. And then when the economic indicators are more clear, let's say it's a -5% recession, then we will allocate more towards a recessionary proof portfolio. And then we also use technical analysis, things like golden crosses and death crosses to determine when and where we changed asset allocation, because sometimes financial markets move very quickly, as you know. And the last thing we take into account is valuation gaps. So because the financial markets are forward-looking and they're a voting machine, sometimes they get it wrong, right? Whether we're right or we're wrong, it really depends on the time frame and how solvent you are to make sure your trade goes well. But if we see some valuation gaps, let's say something is undervalued, for example, gold in 2017, we would actually allocate more of our portfolios towards gold, as we did in that time, and it's proven to benefit our users. So all in all, how this relates to this current situation, the long story short is that the portfolios haven't readjusted, or what we call reoptimized, to this particular scenario. Firstly, because the speed in which it happened was very, very quick. And to make any kind of human judgment and not rely on the system we've built and has been stress tested is basically saying that our model doesn't work, right? And based on our model, of course, the things that are supposed to happen. If you're in a low risk portfolio, you're protected. If you're in a high risk portfolio, you go down a lot, right? In good times, you also go up a lot. So we're seeing a lot of swing in terms of performance for a high risk portfolio. And based on that, we haven't done anything, because we are also seeing that the policy bazookas and the quantitative easing that has been announced, as we've learned from the 2008 financial crisis, will kick in and provide some support. Not saying we're at the bottom, not saying we're out of the woods, right? But we're saying that it gives some support. And if there's some relative value to be had, we might actually increase our allocation to certain sectors.
Hey, this is CS from More Money Malaysia. We are a platform dedicated to helping Malaysians like you make smart financial decisions. And the way we do that is through providing you with actionable advice, such as the video you just saw, right? But we're not here just to become your intellectual entertainment. We really do want to see you succeed, because we want to see you live that ultimate life that you've always dreamt of, right? And in order for us to do that, what we've decided to do is we want to help make it easier for you by providing different types of rewards throughout the months. So make sure you check out the description below, click on that link and see what type of reward you might be able to qualify for by taking action right now. And if you have any other questions about any of this, feel free to contact us wherever you find us. Take care.